This episode is sponsored by Greater Vancouver Tenant and Property Management Ltd. Looking to rent out your home or property? Greater Vancouver Tenant and Property Management Ltd is here to help. With nearly 500 Google reviews, their property management team loves working with first-time and small landlords, providing best-in-class rental and management services right here in Vancouver. Condos, townhouses, houses, multiplexes, the team uses technology and industry best practices to avoid the usual headaches. To get your first 2 months of management free, text or WhatsApp the word BOOMER to 604-256-6930. That's BOOMER to 604-256-6930. That's a special offer for Loonie Hour listeners. I personally use them myself. Highly recommend. Check them out.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 95. As always, joined by the three amigos. We got Keith Dicker here, IceCap Asset Management, Rich Diaz, the Tom Brady of macro. Welcome back to the show, gentlemen. Rich, you sobered up now, buddy?
Just barely. I think I had like some kind of kidney damage. No, I had a great time though. I just want to thank everybody for coming out. It was really, really cool to meet so many people. A lot more first gens than I was expecting. So first gens is what I was told the first generation immigrants called themselves. I thought that was pretty cool. A lot of young people as well. I got a couple of hugs, no kisses. Keith, how did you have? Did you have a good time? Have you recovered?
Well, for everyone's reference, we're talking about the live event in Vancouver.
Oh, yeah. Sorry.
And then the not so live event, which was even a livelier event in Calgary. And what I had a brilliant time. I love both of those places, and everyone is just so nice and kind and engaging. And I hope I was able to say hello to everyone there. If I didn't get to say hello directly, we'll blame it on Steve and Rich. But that was a fun time. I really enjoyed it, and I'm really looking forward to going to Vancouver again. And by the way, the Calgary event, no offense to Vancouver, but I think we need to do the Calgary event again. And because I think people will want to hint, you want to travel over for the Calgary event. That was fun. That was a good time. Rich was on fire, everyone. Rich was the MVP of the Calgary event by a long spot. How about you, Steve? What did you
it was just a really great turnout. I think the Vancouver event was like, the venue was awesome, full packed house there. The drinks were flowing. The audience was super engaged. It was a great time. Then obviously Calgary, we had perfect weather. Keith bought way too much booze, way too much pizza. We had leftovers at the end of the night. The tickets were like cheap. We were losing money on that one. I think it was like $20 for a ticket to come for unlimited booze, unlimited pizza. And in the night, this guy just walks out because we're like, hey man, we got excess. This guy walks out with a 15-pack of buds and a full large pizza, worth the price of admission right there. So it was a great time. But shifting gears here to this week's episode, we've got a very special guest, a good friend of the Boomers here, Brent Johnson. Some of you guys will know him as the Milkshake Man. But we're going to chat with Brent here shortly about, macro markets, what he's seeing, a guy I think that's, widely followed on social media there. And so we're excited to have him on this week's show.
Okay, everyone. Normally Steve does the introduction for all the guests because, Steve is the Loonie Hour and Rich and I just hang out all the time. But we're actually thrilled here today. We have what usually our guests, a lot of them are Canadian based and focused, but we also know there are some really great minds out there that are following the world from a global macro perspective. And we talk quite a bit how maybe a trigger event for something good or bad in Canada will come from outside of Canada. So I just thought today it would be really good to have, he's a very dear friend of mine, is Brent Johnson. And Brent's background, he's very active on different podcasts and social media platforms. Brent developed created or coined an investment thesis a few years ago. It's called the dollar milkshake theory. And we can talk a little bit about that as well. Recently, if you're not aware of it, Brent started his own podcast, and that is called Milkshakes, Markets, and Madness. I think I have that right. So we also encourage everyone to give that a follow, and you get to hear a bit more what Brent is thinking about. And I think people may or may not know, but Brent and I, we know each other maybe a little bit too well. And but we work together a little bit. Maybe Brent can share a little bit about that. And I like to joke that, he probably yells at me once a week on average. On average, right. maybe not.
That's about right.
But yeah. Anyway, everyone, here's Brent. So Brent, how are you feeling these days?
Brent, have you been invited to pizza night yet?
No, he always posts these pictures. He tells me what a great cook he is, but he's never ever cooked me anything or sent me anything to eat or nothing.
Okay, I don't feel too guilty of bad then. I've never been invited either. It's just every week there's pizzas flying on Twitter, and I've never been invited. So there you go.
I've been invited, and it was amazing. So there you go.
I think you have to be here, to get in on the kitchen party. So how about then we start, Brent? I mean, I think this week there was one headline event, or maybe it happened late last week. The days are a bit messed up here. But then there was another event. So the big headline event got all the attention in the media. And in the investment world, we more or less shrugged it off. It's not that big. But then there was a significantly more important event that took place late last week and is carried over into this week. So, obviously, we're talking about the credit rating downgrade for the U.S., and then what the Bank of Japan have been doing. So why don't we just, sort of cue things up with that, and then we'll sort of float around the conversation on that way.
Sure. Well, it is kind of interesting because you would think that, the U.S. debt being downgraded would be kind of a nightmare scenario. And I think for many other countries, it would be. But what's kind of interesting is that, the U.S. debt is what the whole system is based on. So if the U.S. debt goes down, there's not a situation where the U.S. debt goes down and the other debts do not, right? Because it would be like pulling the rug out from everybody and everybody just all of a sudden levitating and it not being a problem. And so, while it's not a great thing for the U.S. debt to be downgraded, it's not necessarily a horrible thing either. And, because the U.S. has the ability to withstand stuff like that because they sit at the center of the monetary universe. And I know sometimes when I say things like this, people will say, "Oh, there goes Brent again. He's thinks that they're the exceptional Americans and they can never do anything wrong and they're better than everybody else." And it's really not that at all. It's really just the design of the system. When you have a system where everything trades relative to everything else. And the U.S., even though they have all these problems, are in better shape than, or have the ability to meet their problems in an easier way or a better way than their competitors, the U.S. is still going to be okay. So it's interesting to see that, the U.S. debt gets downgraded, Treasury yields, go up, and the prices come down, but everybody's still buying the debt. The U.S. is not going to have an issue selling securities. And the same thing happened. What's interesting, the same thing happened about 10 years ago, 12 years ago. And when the US debt got downgraded, treasuries actually rallied. So, you just kind of got to take a step back and kind of understand how the whole system is designed before automatically saying that this is a disaster scenario for the United States.
Maybe one thing that people may not be aware of. So every bank and insurance company around the world, you have what's called regulatory capital and reserves, and they have this risk score that they'll attach to it. But basically, the whole, as Brent mentioned, the whole system is structured and designed so that bank capital gets funneled into the U.S. Treasury market. So if, for example, someone decided that, hey, you don't have to hold treasuries anymore, and say you're any kind of a bank or insurance company in the world, even pension funds. So Brent, which other market could these hundreds of billions of dollars flow into if the U.S. Treasury market was taken offline?
Well, I guess theoretically you could say it could go into gold. That would be a place it could go. It could go to some other sovereigns that now seem to be seen as superior to the United States. But again, or maybe it goes into land, maybe it goes into equities.
Bitcoin.
But again, yeah, or Bitcoin, maybe it goes into Bitcoin. But again, based on the system as it's designed right now, there really isn't a way for the U.S. to go bankrupt or go offline and not, no longer have a demand for its treasuries, but there still simultaneously be treasuries or demand for other sovereigns. Because if the U.S., let's say the U.S. bond prices were to just absolutely collapse and nobody wanted them and yields go to 15, 20, 30%. Well, all these other yields are kind of priced off the treasury as well. So those yields are going to be spiking as well. So it's kind of fun sometimes to kind of think about these theoretical things, but the likelihood of these happening. And again, I'm not going to say that that's impossible. And so I guess you theoretically should be prepared for something like that, but the probability of something like that happening is so incredibly low that to see where the U.S. Treasury would fail, but other treasuries would rally at the same time is.
So wait, are you saying the Canadian market would be influenced by the Treasury market?
Maybe just a little bit.
Maybe just a little bit, because this conversation up here in Canada, everybody in the world, we see the markets through our own eyes and lens, and we do that for so many things. We take our own morals, ethics, and values, and we portray that onto the rest of the world, and that's the way we expect everyone to behave. But we talk about it quite a bit. The entire banking system in the Western world, anyway, it is dependent upon the yield curve, on rates and credit spreads. So if we do go down this road where the Treasury market does get hurt for whatever reason, the Canadian market will get hurt, will get hit as well. And, obviously, Steve, you're going to see it in your business, spreads are going to blow out and stuff like that. Why don't we next?
Well, the other thing too, the other thing I should point out, is if this happens, right? If yields go to, let's say the yields go to 30% and treasury prices fall by 50%. All of the banks, all of the insurance companies, all of the pension funds, all of the, shadow banks around the world who are holding treasuries on their balance sheets are now bankrupt. So credit is just going to collapse in that scenario because their balance sheets are just completely upside down. So again, whether or not you think this can happen or not, or whether you think this would be a good thing or not for this to happen, because the U.S. finally gets what's coming to it. This is not a situation where the U.S. goes up in smoke and the rest of the world's throwing a picnic. It's just not set up that way. And maybe it should be, but it's just not. And I think it's really important to understand that.
And that's why we refer to the U.S. as the 11th province of our country sometimes.
We refer to Canada as America's attic. we let you guys live there, but we all know who owns it.
Well, it is always funny, right? Because I don't know, I always hear it that people in the U.S. they're always like, oh, our country's going to shit, and but we're heading to $1 trillion now in interest payments at the government level. But then you come to Canada and everyone goes, oh man, if as a Canadian I want to get the hell out of here and get to the U.S. You worry about the value of the Canadian dollar. So I feel like there's some of that home country bias that fogs people's views.
I have a question actually that sort of dovetails off of Steve's point, and I'm curious: is this a de facto downgrade or indictment of global government debt?
Yeah, that's a very good question. And again, it's hard to see where you're going to downgrade the U.S. and it's going to be this huge horrible thing for the U.S., but that it doesn't end up affecting and downgrading other countries as well. When this happened 12 years ago, the Standard & Poor's downgraded the United States. A couple months later, their president was fired, or he stepped down due to personal reasons or whatever it was, right? And I think they got a fine. So, at the end of the day, the government kind of controls the rating agencies, or they can dramatically influence the rating agencies. And so, but I think what you're getting at here, though, is that, and I think one of the things that Keith and I have talked about for a couple of years now is that there is this sovereign debt crisis looming, right? But it's not just a U.S. debt crisis looming. It's not just a Bank of Japan or Japanese debt crisis looming. It's not just a Turkish debt crisis looming. It's really a global sovereign debt crisis looming because of rates were held so low for so long, now that they're starting to rise. And because over the last 30 or 40 years, markets have become so globalized and so enmeshed with one another, it's become increasingly hard to have a regional crisis that doesn't spread and have contagion for the rest of the world, especially when it's at the sovereign level. And so, we believe that there will be a sovereign crisis. We believe this is kind of the precursor to a, margin call on global sovereign debt, or however you want to refer to that. And so, but the fact that this happened 12 years ago, and now we're here, and the debts around the world are so much bigger than they were 12 years ago. It's also a reminder that just because this happens doesn't mean everything's going to collapse tomorrow, right? The whole inevitable versus imminent argument, I think, is apropos. Now, we think that we're a lot closer to it than a lot of other people think we are, but it doesn't necessarily mean it needs to show up tomorrow.
So I'm kind of curious. I have what your longer term view is, because I think I'm in the same sort of view and agreement as you that this is a global sovereign debt issue or impending crisis. Are you of the view that how does this get resolved? Let's say 5 years, 10 years, 12 years down the road. Do you feel do central banks just come in and end up monetizing all the debt? Yeah. How do you view this playing out?
I think that's increasingly likely. What ultimately I think will happen, and I don't necessarily think there's going to be one event and that's going to be over. Something will happen. They'll get it under control. Something else will happen. They'll get it. And so I think they'll kind of be this stair step event. But I think in the next 3, 4, 5 years, we will get this crisis. And when this crisis happens, I think the U.S. dollar is going to rise dramatically versus all other currencies. Again, not necessarily because the U.S. is in good shape, but just because they're in two things. They're in better shape than a lot of the competitors. And then the design of the system as it currently is kind of forces liquidity into the dollar. And so what I think happens is the dollar gets so high that it just leads to all kinds of problems around the world. And then the global central banks get together and they come up with this famed global reset where they either write debt off or they monetize it, and in some form or another, then after that's done, then they devalue the dollar from there, because the way the system is set up right now, it is not designed to withstand a rapidly appreciating dollar. And so this is one of the reasons that Keith and I have talked a lot when the idea that the central bank losing control, and a lot of times we'll equate that with the dollar losing value, but it's the exact opposite. The dollar kind of falling or staying lower as the Fed monetizes the debt or provides liquidity. That's the system being perpetuated. What wrecks the system is when the dollar rises too fast and the central bankers can't get it under control. That's what happened in 2008. That's what happened in 2019. That's what happened in 2020. And that's what started to happen again last fall. I think Q3 of last year was a very good precursor or a very good analog for how I think ultimately this will play out. And that is, last year you saw the US interest rates rising because the Fed was raising rates. The Fed raising rates made the dollar appreciate versus foreign currencies. As those foreign currency, the problem is the rest of the world owes debt in US dollars and needs US dollars to operate on the global stage. So the rising dollar caused all these other countries' debt servicing costs and operating costs rise, and it put the whole world into crisis. The US was having problems with inflation, but the rest of the world was in crisis. In August and September of last year, China was struggling to combat their deflating real estate market. The European Central Bank finally raised rates for the first time in 10 years, but at the same time, they had to set up a facility to buy sovereign yields like Italy, because those yields were starting to rise too quickly. At the same time, the Bank of England had to bail out their treasury market because one of their pension funds was going bankrupt or about to blow up, and that was then going to affect the ability for British treasury auctions to function properly. So they had to go in and kind of bail out that market. And all at the same time, the Bank of Japan had to go in and not only not bail out, that's probably the wrong way. They had to do their yield curve control to keep their interest rates and their treasury market under control. But at the same time, they had to bail out their currency market because the yen was just collapsing. And so I think that's kind of I think that's a good way to show how I think it's ultimately going to play out. The US was having a lot of problems last year, but the rest of the world had them in even bigger amounts. And the US markets held up better than those markets did.
Sort of reminds me of that movie, There Will Be Blood. Remember the scene when he had the...
Yeah, that's right. I mean, that's kind of where I got the whole milkshake theory analogy from is, I was trying to kind of figure out how this was all going to play out. This is an interesting story too. I don't know if anybody's ever heard me say this before. I think I've told you, Keith, but it was around that time. It was, I kind of started talking about this in 2018, and around 2019, I kind of started developing the theory more and talking about it more. But I think that's about the time that I first came across one of your quarterly reports. And I don't remember the name of the report, but I distinctly, I can't believe I'm actually going to say this, but I distinctly remember reading this report, and I got done, and I read a lot of reports and I listen to a lot of people, and I read this report and I put it down, and I was actually mad that I didn't write it. It was so well written. And it felt like you had, so that I'm giving you credit here in case you didn't.
I know that. I just like hearing. I'm going to let you continue. You go on with it. I remember the name of the report. I think it was called Return of the King. I think that's what it was. King Dollar was the theme with it.
Yeah. And so, and I had felt like, and I didn't know you at the time. And I felt like, you had like opened up my head and like taken out all my thoughts and written them down in a better organized way than I had. Actually, I think this was more like 2018 rather than 2019. Now that I think about it, but and so then that kind of led me kind of thinking more about this, and then I around the same time I had seen this movie years ago, but then I had seen it again, and that scene where he was drinking the milkshake, I was like, well, that's a perfect way to explain it, because as we get into this crisis, just based on the design of the system and based on the way capital flows move and based on the regulatory aspects of all these markets around the world, what little liquidity there is going to get funneled into the thing that sits at the base of the system, and that's the U.S. dollar, and that's really kind of how the whole milkshake theory started.
Brent, can I ask you a question?
Yeah, go ahead, Rich. Yeah. Go ahead.
Sorry. So just on that, so one way that the U.S. provides liquidity is by running basically twin deficits, if I'm not mistaken. So twin deficits is basically you have a current account balance, which is negative, and you have a budget balance or government budget balance, which is negative. And the two of them together are twin deficits. There's a renewed call in America by certain political operators that are sort of budget hawks, let's say, that want to run balanced budgets. You just described it in a world in which we need American dollar liquidity. And there's, some political class that are insisting on sort of taking that away. Number one, is that sensible? Number two, is that realistic? And number three, always, have I screwed up the question, or do you sort of understand?
No. It's what you're kind of referring to here is Triffin's dilemma. And Triffin's dilemma, for those who aren't familiar with it, it was coined back in, I think, the 60s. And it basically said whenever an individual country's currency is also used as the global reserve currency, you will eventually come into a situation where the needs of the domestic market come into conflict with the needs of the global market. And because for several years and several decades now, the US has been willing to run these double budget deficits, we have not come into this conflict. There has not been the conflict described in Triffin's dilemma. But really over the last, call it 5 or 6 years, it really kind of picked up speed when Trump was president. The whole "Make America Great Again," bring manufacturing back to the United States, bring jobs back to the United States. And then now with the kind of the deglobalization trend, where, for national security reasons, you don't necessarily want to outsource everything to another country. It's kind of picked up speed. And so now you are starting to have the national interests of the United States, who's been supplying the currency to the rest of the world, starting to come into conflict with the rest of the world. And then I think that's played out very well last year. Again, the needs of the domestic market last year were higher rates. It needed to bring up higher rates in order to kind of slow the inflationary effects. The problem is that because the rest of the world owes US dollars and uses US dollars, when the US raises rates, they were also raising rates on the rest of the world, which put downward pressure it put deflationary pressure in dollar terms on the rest of the world. But simultaneously, the rest of the world was also dealing with inflation from COVID, and their currency started to fall dramatically against the US dollar. So they were having inflationary effects being compounded by the US dollar getting stronger in their local currency terms, simultaneously getting deflationary effects from the dollar getting stronger in importing costs and in debt servicing costs. So that is what happens when you try to get away from these twin deficits, right? And so I'm not saying that it can't happen. A lot of people will say, well, the US could never return to manufacturing. Well, of course they could, but there would be a hell of a lot of pain, right? And I think that's the point, is we're not going to have the only situation where things go okay and we don't have an incredible amount of volatility is if everything just goes back the way it was. We continue to expand debt. The US continues to run twin deficits, and everybody goes back to globalization. I think it's pretty well, laid out now that everything is not going to go back exactly the way it was. And so any kind of a transition away from what it was to what it's going to ultimately be, there is not a way to do that is non-volatile, and probably not a way to do it that's non-violent. I hope I'm wrong, but any kind of a transition from that old system to a new system, whether it's a new currency, whether it's the US now running only a budget deficit or no longer running a trade deficit, that's going to have profound impacts, not just on markets, but geopolitics and all kinds of stuff, social issues. So it's a really big mess is the best way to say it.
I mean, the irony, of course, there's a lot of clamoring, as you said, Rich, for the Americans to reduce their budget deficit. But by doing that, it reduces the supply of treasuries being issued, which then would only strengthen the dollar, which would then accelerate a market crisis of some sort of an event. So, I mean, we've talked about quite a bit before. Like, I believe that we are experiencing this, slow shift to a new kind of a financial system coming up. And, as Brent said, that doesn't have to mean it's a, did you hear that, Rich? Was that loud enough?
No.
How, is that better?
Still
Remember,
no.
I try to snap my fingers every now and then. I can never get the fingers.
You never learned.
The fonts. I like the fonts, but I can't get the finger thing. But the point is that, we don't have to dramatically, shut everything down over the weekend and something new overnight, because markets in the private sector were really good at adapting to change. But if we get this sudden rapid change in any market, the way the world is set up today, it is going to attract a lot of money into the dollar market. That's for sure.
Yeah.
Steve, I think you had a question lined up as well, Stephen, before Rich was about to ask one.
No, I was just kind of curious, keeping all of this in mind, what your views were in, let's say, the near to medium term, which is, your US 10 years back towards levels last seen in, 2007. Obviously, we know that the debt that's compounded in the years since then, inflation's still proving a little bit trickier. The Fed's still hawkish. How are you viewing markets in sort of the near term of what's likely to come?
So I think the second half of this year is going to be much more volatile and not as smooth as the first half of the year. And part of the reason I say that is, we're 14, 15 months into this rate hiking cycle now, which is the fastest rate hiking cycle in history for the United States. And a lot of times when you have a rate hiking cycle, the effects of the rate hikes don't show up for 9, 12, 15, 18 months. And so we're kind of right in the heart of that period now, whereas things start to get refinanced. Think about it. Rates in the US were 0 18 months ago, and now they're 5.5%. That's like a 7,000% increase. It's crazy. And so if you had, I don't know, you had taken on some financing, let's say 3 years ago, rates were 0 and your loan was at 2% or whatever it was. And now you have to refinance 3 years later, and rates are 3 times as high as they were, or your rate's now 3 times as high as it was 2 years ago. Your payment's now 2 or 3 times as high as it was 2 years ago, 3 years ago. That's a huge amount that now has to go towards debt servicing that was previously going towards, whatever it was. And so I think we're going to get into that period where that's going to be a problem. The other thing that's happened right now is that, and this is something that Keith and I talk about all the time, is that we don't know that there's going to be a crisis. Maybe the powers that be can kind of keep us going down the road. All we know is that the table is set in a way that if there is a crisis, really bad things are going to happen because things are so kind of mispriced and out of bounds. As an example, everybody knows the dollar had a huge run up last year. It's had a huge pullback over the last 9 months. And now everybody's bearish to the dollar again. Asset managers have never been more short than they are now. The speculative long position in the euro has never been as big, or I think only one time in history it's been bigger than it is now. And so, if we get into some kind of, even, it doesn't even have to be a crisis, but just even a downward trending market, and the dollar starts to get some strength off of, that contraction of credit or slowdown in markets, you could get a short squeeze in the dollar again, and we could end up right back where we were, last September in very short order. Now, whether that happens or not, I don't know, but all I know is that if it does happen, people aren't prepared for it. And one of the ways that I think this could really manifest is I think there's a lot of people out there, because the United States is the biggest market in the world, they focus almost exclusively on the United States. And as a result, they focus on all the problems the United States has. And I don't discount that. I think it's important to kind of pay attention to those problems. But I think as a result, they also tend to overlook the problems that are elsewhere. And the problem that the Bank of Japan is dealing with right now is, I think, incredibly important for global markets for 2 reasons. And that is regardless. So the Bank of Japan, I'll give a little context. Hopefully it won't take too long, but I'll set the stage a little bit. So the Bank of Japan for, let's call it 20 or 30 years, has been running these extraordinary monetary policies. Everything the Fed has done, the Bank of Japan has done it years ago and is continuing to do it. And as a result, they've kept rates at, next to 0 for years and years and years and years. And as a result, as they issued 0 or negative yielding JGBs, Japanese government bonds, all the banks, the insurance companies, the pension funds, have bought this debt at either 0 or negative yielding levels. Also, because rates were basically at 0, if you borrowed yen, there was really no borrowing cost, right? So you borrow yen, and then you go buy something else somewhere that, you go buy emerging market stocks, you go buy, developed market fixed income. That's, even if it's yielding 1 or 2%, that's 1 or 2% more than your borrowing costs that are 0. And so, you could short the yen, you could take that cash and then go buy, assets all over the world. And that's what, market participants did in spades. So there's this huge yen carry trade out there. Okay. The reason that's important is now we're at a place where, after all of these years, in Japan, they're actually finally starting to get a little bit of inflationary pressure. And so instead of rates being at 0, rates have started to push up a little bit. The reason that's a problem is because all of these bonds that were bought at either 0 or negative rates will lose value as those rates start to go higher. And so that has the potential to cause a banking system crisis or in Japan or anybody that's holding JGBs. As a result, the Bank of Japan has instituted what they called yield curve control, which means they will buy however many bonds they have to buy in order to keep those rates low. Okay. The problem with doing that is it has absolutely killed the yen. The yen was down like 20 or 30% last year. And that's a huge move for one of the biggest currencies in the world. So their currency is just getting crushed, which leads to even more inflation, which then tries to push bond prices even higher. Long story short is you cannot say, you can do it for a very short period of time, but over a long period of time, you cannot save both the bond market and the currency market, because the policies that you would put in place to save the bond market will kill the currency, and the policies that you would put in place to save the currency would kill the bonds. So the Bank of Japan is in really kind of between a rock and a hard place. But because of these inflationary pressures, they have said they may let yields rise a little bit. Okay. So here's the thing. If they don't let yields rise a little bit and the currency continues to weaken, then that puts an incredible amount of pressure on China, because China's one of their biggest regional competitors. And if Japan's currency is getting weaker, that means China's goods are getting more expensive versus Japan's, and Japan can outcompete them. Okay. If that happens too much, then it puts deflationary pressure on China, which they're already having trouble dealing with the deflationary forces in their market. And that could cause China to have to devalue their currency, which then would send a huge deflationary wave to the rest of the world. And it would really hit places like Canada, who have I would argue, an overinflated stock market, right? So you would have this deflationary wave come towards Canada, or real estate market. Canada has an inflated real estate market. So that would have two problems. It would send a deflationary wave to the rest of the world, which I think would impact Canadian real estate. But then not only that, the Chinese buyers who have been buying a lot of Canadian real estate, their currency is now devalued. And at the same time that China would devalue the currency, they would probably throw up all kinds of capital controls. So the flow of capital from China to buy more real estate would probably dry up. So this is a way that everything's all connected, right? And so that's the way that if the currency continues to fall in Japan, how it could affect Canada. But the opposite is also true. If they decide to save the currency in Japan and they let the yen appreciate, now that carry trade, remember I said all that capital has been deployed all around the world because there's no borrowing cost. All of that capital that's been placed abroad now comes rushing back to Japan. That's good for Japan. It's not so good for all those places that money was at, because now that liquidity is leaving those other markets. And maybe some of that money's in Canada or the United States or Brazil or, emerging markets or wherever it is. So to me, the reason that Japan kind of sits at the middle, at the very center of, in my mind, kind of global macro right now, is because regardless of which way they go, unless they can walk that tightrope perfectly, regardless of which way they go, it has the potential to kind of create, this global event that we've talked about.
So we have
I hope that wasn't too confusing.
Brilliant.
No, I don't think it was confusing, but I think we have a lot of people who are listening to the podcast who are directly involved in the real estate market, including the king of Kitsilano up there. But you may have just scared the crap out of all the realtors and mortgage brokers in Canada. So if I were you, I wouldn't go to Vancouver again for the next Macro Voices event.
Well, listen, I'll say this: Vancouver is one of my favorite cities in the world. I've been there many times. I love it. I can't wait to go back. And the truth is, I've thought this for several years now, as have many others, and the market just keeps going up. So
the only thing I'd push back on
tomorrow.
The only thing I'd push back on the Chinese stuff is it seems like the only people that are ever allowed to get capital out of that country are members of the CCP.
Well, that's fair. That's fair.
And it's, capital controls for everybody else unless you're connected to the government. And that's where you get a lot of these sort of illicit flows into places like Vancouver.
Sure.
But anyways.
It's kind of interesting, guys.
I think that's probably why it has held up so well, right? And not only that, but the net immigration going into China or into Canada has obviously helped. And so, again, nothing is certain. I've painted a scenario where kind of a really bad thing will happen. And I don't think anybody should run out there and place their whole portfolio on this idea. I just think that they should be aware of it and understand that if something like that were to happen, it's not just going to be a minor little thing. It has the potential to be a very, very big thing.
Rich, you have one more question for Brent before I finish up?
Yeah, it's just a really quick one. So you've outlined sort of what might happen to developed markets that are highly indebted, whether it's Switzerland or, Canada, Japan, I call them the 300% club. Yeah. Countries with 300% of debt to GDP. This includes non-financial corporations, households, and government. And then there's obviously a bunch in the 200% club.
Canada's at 365, by the way.
Yeah, but there's a 200% club, which is the US and the UK and Italy and whatever it is. But there are certain countries that sort of, whether, on purpose or maybe not, that just do not have any debt to GDP, basically. And so I would think of something like Mexico. Now, I understand maybe in the initial stages, people would like pour out of the Mexican peso and into the US dollar. But do you see it is different this time. Whereas, we've had sovereign debt crises. We had the tequila crisis in the 90s. And then in the late 90s, we had the Asian sovereign debt crisis. But there are a bunch of emerging markets that basically really just have not levered up at all in the same way. How do you feel that would play out in the scenario that you've sort of described? Again, maybe not the initial stages, because I agree with you, the dollar would bounce, but do you treat them differently?
I don't necessarily treat them differently. And I agree with what you're saying. I think to your point, in the initial stages, I think capital would flee those locations, and I think they go to the US dollar. And so in some ways, I think that they would get hurt. And as a result, I don't want to have any exposure to them right now. But after the initial stages of it, then, after liquidity is left, then you're going to want to look around and say, who has the best balance sheets, right? And to your point, they have some of the best balance sheets. So I think if you have the opportunity to buy them at a big discount, then that's probably a good thing to do. And I think ultimately, after this whole developed market crisis plays out, if you're able to buy these emerging markets or some of these frontier markets at very good prices, that's probably the next big trade after this one.
That's a great place to wrap it up. Keith, do you have any final parting words here? I want to be respectful of Brent's time, obviously.
Yeah, sure thing. I just want to share. I didn't introduce this in the beginning when Brent joined us, but Brent's firm is Santiago Capital. Brent manages money for family offices and high net worth private clients down in the US. So if anyone is listening, they're in that market, Brent is more than happy to chat with you. And I know I alluded to it a little bit, but Brent and I, we do manage money for some of the same clients around the world. And we also have a special purpose vehicle that is set up to benefit if one of these events would happen, sort of moving with the US dollar. So that's sort of the connection that Brent and I have together. I know people have asked that before. Does that make sense with you, Brent? Is that a good way to describe it?
Yeah, and it doesn't. And I'll tell everybody, part of the reason that Keith and I have begun working together over the last 4 years, and we continue to do more and more stuff together. Not only, again, I alluded to that first time I read his report, but then, we started talking, and our philosophy is very much the same, and we kind of think about markets the same. But the other thing, quite honestly, is that Keith has a fantastic track record. I know he probably never talks about it, but a lot of times you'll talk to smart people, and you get a good feel for them. But then if you look at their returns, they're fine, but they're nothing special. But when I started talking to Keith and asking him how he managed money, and we kind of were on the same page. But then he showed me his track record, and he's never lost money in 12 years. And think about all that's happened since the global financial crisis and all the craziness. And through all of that, he's been able to manage his strategy without a drawdown. So, that's pretty impressive. And I know he doesn't talk about it, so I'll talk about it for him. Anyway.
It's kind of like the Step Brothers movie, you have that love and dislike relationship sometimes.
I'll yell at you later, not on this call.
Thank you very much. Okay, Brent, thank you for your time. That was a great conversation. And so we'll chat again soon. I'm sure we'd love to have you back. One thing people don't realize, we're trying to encourage Brent to meet us in Vancouver for the event, but it just didn't work out with his schedule. He's traveling quite a bit. So maybe at some other Loonie Hour event in the future, you might see Brent hanging out with everyone. Okay, thank you for your time, Brent. Okay.
See you guys.
That was a great interview with Brent there. Hopefully everybody enjoyed it. We'll definitely have him back on the show again, but just to kind of switch gears here on the Canadian front, what's happening more domestically. Of course, we've got, residential real estate sales, some of the data coming out of Vancouver and Toronto housing markets. In Vancouver, kind of a mixed bag. If you look at the headlines, sales are up. New listings were up, and ultimately when you unpack it further, so sales are up 28%, listings up 17%. But inventory running at its lowest level. So basically what it is the number of homes for sale available on the MLS system as of the end of July. We're at the lowest levels for any month of July dating back 20 years. And so this is the ongoing sort of story here. It's just, there's just not a lot to buy. And so despite mortgage rates being at 6%, this is the only reason, in my opinion, why you haven't seen house prices declining, is because it's hard for prices to decline. There's nothing to buy. And so we're still seeing multiple offers happening, especially for entry-level product, houses, condos. I would say that prices, in my opinion, have stopped going up, but it's still a really tight market. And so it's certainly making the Bank of Canada's job harder, right? Pushing rates up as much as they have and not seeing any real house price declines. Because, like I said, a lack of inventory. I know we've chatted about it in the show. I would argue that the Bank of Canada, or through higher interest rates, it's actually ended up trapping people into their houses because it's hard to qualify and hard to upsize when you got a stress test at 8%. So people are just kind of staying put. They're not listing and they're not buying. And so it's a pretty dull market. That appears
this is
to
the
be
pause that you talked about in Vancouver, right?
Well, yeah, I mean, the unpause, which is like, listen, I think there's more downside potentially coming, but the only issue is that you need inventory for that to happen. And so I still believe it's a race basically between, okay, our rate's going to drop. I personally think they will at some point. Maybe it's 8 months from now, maybe it's 13 months from now. It's a race between inventory and interest rates. But like, it's tough because, one of the ways that rates are going to come down, I think, is through economic hard times, right? It is going to be through more job layoffs. So, it's not a great setup for housing. I think everybody's aware of that. But like I said, the only thing that's underpinning the market right now is there's no inventory. And so long as there's,
sorry.
Well, so long as there remains 10, 15, 20-year lows inventory, it is a simple supply demand function.
And it's hard to ramp that up. You just can't hit a dial. And it's not like, what's that game, Rich? The Sim City, you build things.
I love that game.
Yeah,
well, it's interesting. Yeah. We've always talked about markets being interconnected and so just go around and look. It's same things happening in Australia, same things happening in the US. These housing markets, despite rates going up, are remaining resilient only because there's no inventory, and so everybody seems to be having the sort of same challenges in their housing markets.
But that's true for some segments. But would you say that? How would you feel if someone said to you there's actually lots of inventory in sort of the apartment area, right? So if you look at housing starts and housing completions in Canada, single family homes have been flat forever. But the apartments have sort of gone through the roof. And I'm starting to see some articles kick around about how there's some issues with condo sales and those pre-sales that you always talk about.
Yeah.
And in Toronto. And I mean, I know this is not my lane, but I was just asking about,
it's a good question. I think units under construction for the apartment side is definitely elevated, but I think it's also when you strip it out, the composition of housing is changing, right? We're not building single family houses anymore. We're building multi-units. And so if you actually look at how many completions are we averaging a year, and the number of completions, I think for 2022 was the lowest in 5 or 10 years. Okay. So it's you got a lot of units under construction, but I don't know. I'm pretty skeptical that it's a market that I do think there's going to be losses in the investor space, people that overpaid on pre-sales. I think it's a very speculative market there. People have been overpaying for a while now. And I do think that you're going to see investors, they're going to get hit for sure. I strongly believe that.
But surely,
there she is
surely,
again.
there she is. Surely there must be some changes taking place in Ottawa that might alleviate the housing supply.
Yeah, you
challenge.
teed me up for that one, Boomer. So everybody knows going viral here this week was Justin Trudeau, of course, fresh off his cabinet shuffle there, did a presentation in Ottawa for some new social housing or something they were building, some ridiculously small amount of housing, and to which he basically said, housing is not. He says, I'll be blunt, housing is not a federal responsibility. And then he went on to say, well, federal housing is not a responsibility, but doesn't mean we shouldn't be trying to do something. And so like that, someone basically, they clipped that out and it went viral. Like everybody was upset, even his supporters, and just the wrong thing to say. Like I said, I mean, these guys just can't seem
It was about 5 or 6 years ago. He said the exact opposite.
Course.
In an interview.
Well, yeah, when they
it was
were
one of his,
when
in 2015, it was one of his platform it was one of his in the UK they call it a manifesto. Here, it's one of his platform promises, wasn't it, to make housing more affordable?
Yeah, I mean, 2015, I think he arguably, one of the reasons he got elected was because the young guy coming in that was going to do something about the housing market, make housing more affordable. He kind of campaigned aggressively on that. Same thing again in 2021 during the sort of, I guess, re-election campaign there. He pushed hard on housing again. And, here we are. Right. So,
but the irony, of course, is that he's right, though.
No.
Right. I mean, in part he is. I mean, letting, 1.2 million people obviously doesn't help, but we've discussed it on the show before. It's a municipal and local issue. But he got, he campaigned on something doesn't have an effect on. I mean, correct me if I'm wrong.
I'm not. Yeah. So I'm going to agree on the supply side. I think on the supply side, yes, it's obviously municipalities definitely have a very large role to play. But on the federal side,
the demand side,
you control immigration, first of all, number one. Yeah. But number two, OSFI is a federal government regulated institution. So that's your banking regulator. CMHC, federally regulated. Bank of Canada, I'd argue, is kind of more so at the federal level.
Yeah, and then they're independent. Leave them alone.
And of course, you've got your economic plans, right? Which is, how you're running budgets. If you're running these massive inflationary deficits, like obviously that's, you look at, Rich, you talk a lot about like productive investment in this country continuing to slide lower and lower and lower. And it's like, yeah, I would argue that's federal. And so this malinvestment continues to sort of end up into real estate speculation, because I think there's the entrepreneurial spirit in Canada.
Yeah, it's the only way you could get rich in this country for the last 20 years is by buying. I mean, we're joking now,
but that environment is created, I would argue, at the federal level, right? I mean, It's so restrictive and punitive to actually start a business in Canada,
or to mine, or to build pipelines, or to what have you. Okay, fair enough.
So I just think, I don't know. I think it's ridiculous. Expanding on that front, we talked about obviously the demand side, immigration. Key lever at the federal government level. So out this week was, I think it was actually just yesterday, the new housing minister in Canada, he came out and said, it was in a Bloomberg article, that they are going to maintain or potentially raise immigration targets at their upcoming November announcement. So he says they will not be reducing immigration targets. They will be maintaining or potentially raising them come November. So clearly, I don't think Ottawa is listening to the people, which I think society is upset. I think people are frustrated with what's happening, not only with housing, but with, public infrastructure, getting access to medical care and whatnot, that the infrastructure is struggling to support, 1 million new people a year.
But Steve, isn't the minister who was not in charge of that, the minister in charge of immigration in Ottawa, isn't that person now the new minister in charge of housing, affordability, and everything? It's the same person, right?
Yeah,
it's like a Jack, Janet, Terry, Chrissy episode.
The previous immigration minister was Sean Fraser. So he's moved from immigration to housing. So now he's the housing minister. And now your new immigration minister is a guy named Mark Miller. And so he's saying that they're going to be looking to actually potentially raise immigration targets come their announcement, which is expected in November.
I know we're not talking about the BOC today, but that to me just means this higher for longer is just back on the table. I think all the cuts got priced out, we know, but I was reading the minutes again from the BOC's last meeting, and there's a whole paragraph basically on that excess demand, and it all comes from immigration, and it'll just be really interesting to see the tension and sort of what part of the economy sort of wins out, the like excess demand that's above, your output, your potential output, versus the slowing from higher debt servicing and, weaker wages. It'll be really interesting.
Well, I think TD Economics wrote a piece on that. Just gonna pull it up, but they wrote basically in their opinion, they wrote a piece that said they have the neutral rate of interest it would effectively be 50 basis points higher than it otherwise should be due to the levels of immigration. So they're kind of knocking on that. And then they also wrote a piece that's saying TD estimates that Canada could fall short of supplying demographically driven demand requirements by about 215,000 units over the next 2 years, as strong population growth collides with the down cycle in housing construction. And if Canada repeats last year's cycle of record inflows, then the supply-demand gap for housing swells to over 500,000 units through 2025.
Is there a wrinkle that we're not? Oh, sorry. Go ahead. Sorry.
Well, this kind of comes on the back because, Sean Fraser just took over the housing file. And so he was out saying, yeah, listen, we're going to ramp up housing starts, and maybe he thinks he's going to have the same success he did on the immigration side. But I would argue, Keith, I think that how is he going to incentivize the private sector to build housing right now, to ramp up housing starts, when your cost of capital, which is one of your largest inputs in new construction, is up 500 basis points?
I mean, there's lots of ways they can do it. I mean, the challenge, of course, that a lot of housing starts they're not by mega corporations. They're small to medium size.
I don't think there's any I think there's one or two maybe publicly traded developers in Canada.
Most of them they're just
all private money.
Just guys making building a house and stuff. But if we're in the situation, and this is it is what it is, you have to subsidize the builders or protect them against losses,
which is insane. I mean, it's
try imagine putting that through the system. I mean, they couldn't even properly manage some kind of.
Well, you can underwrite their financing. I mean,
CMHC does that.
Yeah, but even the financing, Rich, it has to be if I don't want to build a house because I'm concerned, I want to take a loss on it.
Yeah,
and I know you can't build it because you would show up with a chainsaw and knock it down. But if we're going to build a house and three of us together and we say, hey, we might make 10% or we could lose 40%. So the way the government would encourage us, they would say, okay, guys, we will cover the first 30% of losses. And then we would say, okay, yeah, we'll take that opportunity.
Yeah.
But again,
I think there's no way that's going to happen.
Yeah, you're right, Steve. It's impossible.
I mean, I guess what they could do, and I think arguably what they should be doing is they should be, they already, the federal government obviously owns a lot of land to begin with. They could be actively going out there and building government-owned buildings, sort of, I don't know if you want to call it social housing, but purpose-built rental buildings that are owned by the government or owned by CMHC.
I have a question about this. I think last year at this time we talked about the growth versus value trade, and it was because we know that a lot of people who come to Canada go to basically two places, Vancouver and Toronto, and that's obviously putting a lot of pressure on those two jurisdictions. Have you seen evidence of people sort of making the value trade? So saying, saw this, I'm going to go to a second tier or third or even fourth tier where the vacancy rates for rentals are just naturally much higher. And seeing, are we seeing any of that flow?
I think you're just seeing the flow into places like Calgary, Saskatoon. People were like, hey, listen, cost of living's more affordable. Maybe this isn't my first choice of places to live. But like, listen, I also prioritize, the ability to raise a family and not be, burdened by a massive mortgage, or rents that are taking 50% of my income. And so I think we are seeing in migration patterns, people moving to these more affordable cities.
But it's still, from an anecdotal perspective, like here in Halifax, like it's the same supply story. There's not a lot of supply. If you want to buy, then you're just bidding up, the few available units that are out there. The rental market, is definitely a seller's market as well. So I understand, like, a lot of people have traded down. They sold Toronto, moved to Halifax, and work remotely and stuff like that. But I just think it's a national challenge. There are going to be pockets where they have the space and opportunity to build. But if you don't have the builders to do it, how are they going to bring it online?
Yeah. I don't know.
We're not offering any solution here to anyone listening, of course, but it's a conversation everyone is having. And maybe the best case scenario is, and again, I like to work in extremes, but let's just say in 24, no immigration, zero. We need 3 years to catch up on everything. So housing, education, healthcare, infrastructure, you go down that list. Because if they don't do it, it is going to create this extreme moment when, as Brent mentioned earlier, maybe the financial shock comes from outside of Canada, which does trigger a pretty deep recession. And all of a sudden, then, it becomes really difficult to try to find someone who wants to build, because they're going to say, no way, I'm going to lose money on this.
Yeah, I think it just comes down to, like, I think we're seeing that now. Obviously, Rich, you and I have talked about it more offline, but just the number of news articles coming out of mainstream media, CBC, CTV, Global News, Globe and Mail, etc., writing articles, questioning the number of immigrants or immigration that we have coming into Canada. Those articles would have not been written 12 to 18 months ago. In fact, I would argue that if you had brought that idea up, you'd be considered, xenophobic.
I was.
So
my dad's from Africa. My mother's from Portugal. I'm like the immigrant story. And I made that comment on Twitter and I got caved in.
Yeah, but you're also adorable looking. Look at you. Come on.
I think that's the frustrating part. Last piece on this immigration thing. I just all we're saying is to lower it slightly. Like nobody who we talk to about this subject is saying it should be zero. It should just be like, hey, let's, instead of going from sixth gear, you put into third gear. It's just, anyways,
I hear you. So I think we've only got about 5 minutes left here. Let's just do a around the horn here. Quick roundup. But Rich, you've got a few data points you're looking at. Obviously, with the Bank of England raised another 25 basis points.
Yeah, I just want to go quickly over what they said and why it sort of relates to Canada, I think. So the Bank of England raised interest rates to a 15-year high. And they said the fight for inflation may require yet another, or much more, require tighter borrowing conditions for an extended period of time. Always keeping Canada in mind when you're sort of thinking about that, because I think Canada is sort of dealing with similar, not the same, but similar issues. And it said sufficiently restrictive for sufficiently long. So leave it to the Brits to make it complicated and fancy sounding, basically higher for longer. We talked about this. Part of the reason that that's happening is the housing piece related to what you brought up a couple of weeks ago, Steve, which is the mortgage interest payments. And something that I brought up many times is the services component of their inflation. So yes, goods are falling, driven by energy. We'll talk about that next week because I think we're going to see a rebound there. But it's the services component, the housing component is just continuing to put upward pressure on the BOE, Keith. And yeah, so that's my simple
couple US data points as well. We had the ISM prices paid.
Yeah, the ISM I think it rose slightly, but it's still below the 50. I'll note that Brent Johnson used 2 great pickup lines. Well, I didn't want to interrupt him. I'll let the viewers sort of figure out which ones they were. But I'm just looking at it quickly here. I mean, you're just seeing it's basically of the 10 components, new orders, production, deliveries. That's probably a good thing as backlogs and supply constraints sort of shorten up. One thing that I thought was actually interesting was the employment. So is contracting, and it's contracting faster. So some of the other components are still contracting, but they started to take the edge off. The employment piece started to contract at a faster rate. And remember what the Fed's been waiting for a long time, which is the labor market to slow down before. So that's something to keep an eye on going forward. I'm interested into next week's services ISM, Keith. I don't know if you have anything to add.
Yeah, 2 things. First of all, today's Thursday. We record on Thursdays, but Friday we get the U.S. non-farm payroll number. So the jobs number for the Americans come out tomorrow, which is your today, or it was your morning.
Oh, yeah, as you're listening to this,
now
you already
so
have
confused.
that number.
Yeah, there we go. But that's going to be a pretty big market mover. But
what's
this
the
week,
expectation on that one, Keith? Just for our listeners here, so like I said, they're going to be listening to this. They'll probably already have the number, but
my Bloomberg shut down from inactivity, so
you
I don't
pay
have
the bills or what?
No, from talking to you guys for an hour. I forgot to toggle my screen. If you know what I mean, but just something real quickly. So, I think Brent talked on it a little bit, but this week, the Bank of Japan, they had to intervene in the bond market twice, like 2 days in a row. So the 10-year went from 0.5% up to 0.6%. And the Bank of Japan lost it. They spent about 3 to 5 billion USD equivalent to keep the yield where it was, right? The next day, it happened again. It went up another 10 basis points. So again, just to express how sensitive that market is. And that was the market event that's caused the big risk off day over the last 2 days, especially yesterday. So again, yesterday it was a major risk off event. Equities were down 1 to 2, 3%, which market. The US dollar was just on fire yesterday, especially against the yen. But this is the environment now we're into. Because it's been a pretty good year so far for risk on assets, but it changed on the dime. And it wasn't Canada, it was the Japanese that triggered it. So that's what I thought was really interesting and, exciting, because if you manage money, you're not excited these days, then you're in the wrong world, because we live in a period of extremes, and it's coming at us pretty good. Yeah, it's fun.
On
Work is fun.
On your non-farm payroll, so economists polled by Reuters expect the U.S. to add 184,000 jobs in non-farm payrolls in July, which would be the lowest since the pandemic recovery started. So we'll see what that number comes in at. But
so just a little wrinkle there, which, sorry to interrupt you, Steve, but what's interesting about that is that the ADP number, which is the accounting software company, whatever, they came up with a huge number. I was like 360 something, if I can't forget. Correct me if I'm wrong. So
yeah, it was huge. Which, keep in mind, I guess all these numbers are always subject to revision. But just to round it out, I think it was a great conversation this week. I think Brent made a really, the point I really kind of take away from that whole conversation was like, if you're Canadian and, if the world's going to hell in a handbasket, like, it's like, well, what do you want to have like the vast majority of your wealth denominated in? Like, what currency do you want to have the vast majority of your wealth denominated in? And it's like, I can tell you, like, my first choice would not be Canadian dollars. That's all I'll say.
The answer is, so, in general, real easily, if the world is not doing well, you want dollars. If it's going to do very well, you do not want dollars. You want to hold Canadian dollar, pound, emerging markets especially. We just happen to be in a market right now where it could, tilt more towards the dollar world. Anyway, there she was, Steve.
There she was, gone. As always, guys, appreciate your support, and we'll see you next week.